In this episode, we are going to talk about what equilibrium is, how and when to use it. Equilibrium is a concept that is used in almost every single ICT strategy. By the end of this video, you will know everything about equilibrium. So let's get into it. So the first thing we need to focus on is understanding Confluence. This is something I strongly believe in. If you don't actually understand the confluences you're using, then you really need to ask yourself why you're even taking that trade. As traders, we should have complete confidence in the reasons behind our entries. That confidence only comes when you understand what your confluences are doing to price and why the market is expected to react from those areas. A lot of people trade by saying, step 1, step 2, step 3, and now I buy or sell. But the real question is, do you actually know why you're risking money on that trade? Personally, I'm not comfortable putting my hard-earned money into the market just by following a step-by-step plan that someone explained in a short YouTube video. I want to understand the logic behind the strategy, not just follow rules blindly. When you truly understand why price reacts at certain confluences, it gives you the confidence to execute trades properly. You're no longer guessing. You know why the market should move from those areas. Now, before we talk about how to mark equilibrium on the chart, we first need to understand what equilibrium actually is. Equilibrium is simply identified in an uptrend by drawing from the swing low to the swing high. To do this, I use the Fibonacci tool, and I apply my custom settings so that the 50% level represents equilibrium, giving me the exact visual I'm looking for on the chart. All this equilibrium line really does is separate price into two areas. Above equilibrium is considered the premium price range, and below equilibrium is considered the discounted price range. Now, if we're in an uptrend and we're looking for buy opportunities, where do we ideally want to enter the market? Obviously, we don't want to be buying when price is already in a premium range. Instead, we want to look for entries when price is trading in a discounted range. If we break it down to the basics, trading is simply about buying low and selling high. So in an uptrend, we want to buy at a discount and take profits in premium. Of course, trading is more advanced than just that, but this is exactly what equilibrium helps us identify. You also have to think from a market maker's perspective. Are they going to want to enter large buy positions when price is already trading high in premium? Probably not. They want favorable prices. So when price pulls back into a discounted range, and we start to see buy orders getting filled from that area, what can we assume? We can reasonably expect price to move higher from there, making that discounted area an ideal zone for long entries. Now, this concept works the same way, but in reverse, when we're dealing with a downtrend. In a downtrend, equilibrium is marked by drawing the Fibonacci tool from the most recent swing high down to the most recent swing low. This allows us to clearly define premium and discount within bearish conditions. So let's say price makes a high, then pushes down to form a lower low. We now have a clear downtrend structure, lower highs and lower lows. In this case, the area above equilibrium represents premium, and below it represents discount. You might be thinking, why would I want to enter in premium if we just said we don't want to trade there? And the answer is simple. That rule applies when we're looking to buy. When we're looking for short positions, we actually want to enter in premium because we're planning to sell high and buy back lower. So ideally, we want to short from premium and cover those positions in discount. That's how profit is made on short trades. When price pulls back into a premium range during a downtrend, and we see sell orders getting filled from that area, and price pushes back below equilibrium, what can we assume? We can assume that selling pressure has been confirmed and price is likely to continue moving lower. This is because premium pricing gives market participants an optimal area to enter short positions to continue the existing downtrend. Once that selling is confirmed, price is likely to take out the previous low, form another lower low, and continue that bearish structure. This is why equilibrium is one of the easiest confluences to understand, but also one of the most powerful, because it helps us identify where price is most likely to retrace before continuing its move. Now let me show you some examples of where we are not trying to mark equilibrium. On the surface, equilibrium sounds very simple, especially the way I just explained it. But in practice, this is where a lot of traders still get confused. And that's completely fine. That's exactly why we're breaking this down step by step. So let's slow it down and walk through this clearly. Let's assume we're in an uptrend. Price makes a high, then a low, then a higher high, and then a higher low. That's standard bullish structure. Now we reach the point where price has just put in a new low, and then it pushes up and forms a new high. At this moment, we're looking for long opportunities because we're in an uptrend, and we're aligning confluences, like equilibrium, that support higher prices. Let's focus on this current structure. This right here is the most recent swing low. Once price forms this new high, that is when equilibrium can be marked. So how do we draw equilibrium in an uptrend? We draw it from the most recent swing low up to the most recent swing high. Do we draw equilibrium from an older low to a newer high? No. Do we draw it from a low that has already been invalidated by newer price action? Number. The key word here is most recent. If there are newer lows that formed after an older one, then that older low is no longer relevant for equilibrium. We always anchor equilibrium using the most recent low and the most recent high. Once equilibrium is drawn correctly, where do we expect price to retrace into? Into the discounted price range. And why is that important? Because that discounted area becomes optimal for looking for buy opportunities, especially once we start seeing buy orders getting filled from that zone. From there, what can we reasonably expect price to do? We can expect price to continue higher and take out the previous high, continuing the uptrend. This is why equilibrium is what I like to call a continuation confluence. It helps us identify where price is likely to retrace before continuing in the same direction. This is different from something like a liquidity sweep, which is typically a reversal confluence. Liquidity sweeps usually involve price pushing above or below a level and then reversing direction. Equilibrium, on the other hand, is used when we expect the trend to pull back and then continue. Now let's flip this concept and look at it from the downside. If we're in a downtrend, we're making lower highs and lower lows. Once price puts in a new low, how do we mark equilibrium? We do not draw it randomly or from an incorrect swing. Equilibrium in a downtrend is drawn from the most recent swing high down to the most recent swing low. That defines premium above equilibrium and discount below it. And yes, in a downtrend, we do want to look for entries in premium because we're looking for short positions. So when price pulls back into premium during a downtrend, what are we watching for? We're watching for confirmation that the trend is going to continue. That confirmation can come from a lower time frame shift in order flow, such as a break in structure or an inverse fair value gap. Once that confirmation appears, that becomes a high probability entry area. And where do we expect price to go next? Below the previous low, because equilibrium is a continuation confluence. And in a downtrend, continuation means more lower lows and lower highs. So naturally, the next move is another lower low. Beautiful. Now let's look at this directly on the candlestick chart, because for some traders, seeing it visually makes everything click. So we're going to switch over to the 1 hour time frame. This is a solid example of equilibrium in action. Previously, the market was operating in a market maker sell model, but then we get a clear break of structure to the upside with this strong bullish move. That shift is important. After that break of structure, the market transitions into a market maker buy model. So now our job is simple. We identify the newly formed highs and lows created after that move. What do we have? We have a clear swing low formed after the impulse, and then a swing high. From there, we mark out equilibrium using those 2 points. Now, if I'm looking for a buy, where do I want to enter? I want to buy at a cheaper price. Where is the cheaper price? Below equilibrium. I don't want to buy when price is trading at a premium. I want price to retrace below equilibrium into discount, wait for confirmation, and then look for an entry. For targets, I'm simply targeting the high of the range. I can scale out partial profits at those highs and close the remaining position once price reaches that level.
And as you can see, price did exactly that. It didn't move aggressively, it was slow, but eventually it reached our targets. And that's all that really matters.
So that's how I personally use equilibrium within market structure to find high probability continuation trades. Remember, equilibrium by itself is not a strategy, it's a framework. When you combine it with proper structure, order flow, and confirmation, it becomes a powerful tool instead of just another line on the chart. If this video helped you understand equilibrium more clearly, make sure to like the video. It really supports the channel. If you want more price action and smart money-based content like this, subscribe, because I post these breakdowns consistently. And if you have any questions or want me to break down another concept, drop it in the comments. I read them. Trade patiently, manage your risk, and I'll see you in the next one.